Hello, everyone. Good afternoon, and thank you for joining me today on the weekly For Trade webinar. In this webinar, we will focus on technical analysis and some basic, actually, of technical analysis. If you have any question, please feel free to ask as many questions as you want and as you need. So just type them in the question box, and I will try to answer it after the presentation and webinar. So first I need to start with risk disclaimer. And just to emphasize 3 points. As for trade, you trade contracts for difference. Trading CFDs and other leverage products carries a high level of risk to your capital as prices may move rapidly against you. Be aware you can lose all but not more than the balance on your trading account. CFDs may not be suitable for all clients, therefore ensure you understand the risks and seek independent advice. You can find the full risk exposure statement at ForTrade website. So, okay, let's start. And in this webinar, we will focus on a technical analysis. First, we will talk a little bit about the types of markets. Then we will focus more on few basic and the most commonly used technical indicators like moving averages, RSI, MACD, and Bollinger Bands. At the end, we will try to do some confluence combination of these indicators and how to use them together in trading. Technical indicators can be confusing for beginning traders especially, but they don't have to be. So in this webinar, I'll try to give you some basic understanding of some useful technical indicators to help you make profit in the market. Firstly, all indicators I'm going to show you all take their information from basic price action. One of the most common mistakes traders make with technical indicator is that they overload their screens. Only display the indicators on charts that you're actually going to use. A lot of traders overload their charts indicators as an excuse just to overtrade. Remember, indicators are indication of something happening in the market. So they are not a crystal ball trying to predict the future. So don't and you should not blame the indicators when a trade doesn't work out. No matter which of them you use, you should be aware that from time to time you're going to lose money and lose trades. So all the trades cannot be profitable, as simple as that. So there are two main types of the market, trending market and range bound or sideways market. Trending market look like this. And here the market is moving in one direction. Also, this should be and could be the trending market, and this is the downside. A range bound or sideways market look like this. Here the market is moving up and down within a specific range. Indicators tend to be suited to either trend or range bound and sideways market. So moving averages now. First, we are going to talk about moving averages. I'm not going to talk here about the formulas. I will just explain the basic concept and the way how to choose option on the platform to suit the best to your trading style. So mostly used moving averages is in trading are simple moving average and exponential moving average. And here I will focus on them. Simple moving average is it just simply takes the sum of all past closing prices over the time period and divides the result by total number of prices using the calculation. For example, a 10-day simple moving average takes the last 10 closing prices and divides them by 10. A 50-day simple moving average takes the last 50 closing prices and divides them by 50, and so on. The 10-day moving average is more responsive to price changes than the 50-day moving. In general, traders can increase the responsibilities of moving average by decreasing the period and smooth out the movements by increasing the period. Exponential moving average. So just one thing. Exponential moving average focus more on this is takes more complex calculation, so I will not focus on that in this webinar. And it places a higher weight on more recent data points. So while this calculation is beyond the scope of this webinar, you should just remember that exponential moving average is more responsive to new information relative to the simple moving average, as it is more focused on most recent prices rather than on a long series of data points as the simple moving average required. Simple moving average weighs the same all data in the sequence, while exponential moving average weights more the most recent data. For exponential moving average, the shorter the period, the more weight applied to the most recent price. And exponential moving average is used to capture shorter trend moves due to the focus on most recent prices. With this method, an exponential moving average supposed to reduce any lags in the simple moving average. So the fitting line will hug prices closer than a simple moving average. So here we have exponential moving average, which is closer actually than the price, and the simple moving average, which is the red line. The exponential moving average works well until prices break the fitting line. During high volatility markets, you could consider increasing the length of the moving average. You can even switch from exponential moving average to simple moving average, since simple moving average suits out the data much better than the exponential moving average due to its focus on longer term means. So how to use moving averages? Moving averages are helpful for identifying current trends and support or resistance levels, as well as generating actual trading signals. The slope of the moving average can be used as a gauge of trend strength. In fact, many momentum-based indicators look at the slope of the moving average to determine the strength of a trend. Many technical analysts often look at multiple moving average when forming their view of long-term trends. When a short-term moving average is above long-term moving average, and for this, I think that we should go here, and it will be much more clear to see. So here we have a longer-term moving average, which is a green line, and faster or shorter-term moving average, which is a red line. So when a short-term moving average is above a long-term moving average, which is a green line, that means that the trend is higher or bullish, and vice versa. Short-term moving average is below long-term, that means that this is a bearish trend or downtrend. So another way how you can use moving averages is through crossovers. So moving averaging can also be very useful to identify the trend reversal in several ways. So first one, we will look here, for price crossover. The price is crossing over the moving average. By price, we mean these candles, which are forming our trends or sideways consolidation. So the price here, it's crossing over the moving average. And this can be powerful sign of trend reversal, while the price crossing above, here as we can see here, the moving average indicates a bullish breakout ahead. Often, traders will use a long-term moving average to measure these crossovers, since the price frequently interacts with short-term moving averages, which creates too much noise for practical use. So here, in these two pictures, we can see that here price is moving above moving averages, and this is our longer term moving average, so which we are going to use more, and it will be better to use it more than frequently than this short one, because as we can see here, it's not very useful because of the volatility of the market. So here is a situation, where the price is actually crossing below the moving average, and this indicates the bearish breakout it's had. Again, the better signal is with this lower moving average. So this is crossover with price and moving average. And the next is moving average crossover. So short-term moving average crossing over long-term moving average. Short-term moving averages crossing below, it's here, long-term moving averages is often a sign of a bearish reversal, while a short-term moving average crossing above a long-term moving average could precede the breakout higher. Okay. Longer distance between the moving averages suggests a longer-term reversal as well. For instance, a 50-day moving average crossover above 200-day moving average is stronger signal than a 10-day moving average crossover above 20-day moving average. Okay, so here we have, for example, this is the 50 period moving averages, this is 10, same. So here we have a faster moving average crossing from the upper side to the down, and this is signaling actually the downtrend. And this is the opposite situation where we have a faster moving average breaking through and going up over the slower moving average, and this is signaling the uptrend. The next indicator we're going to show you here is RSI. The Relative Strength Index compares the magnitude of recent gains to recent losses in an attempt to determine overbought and oversold conditions of instrument. As you can see from the chart here, is from 0 up to 100. An instrument is deemed to be overbought once the RSI is approaching 70. Sorry, this is a 70 level, meaning that it may be getting overvalued and is a good candidate for pullback or reversal. Likewise, if RSI approaches 30, like here, it is an indication the instrument may be getting oversold and therefore likely to reverse. Traders often use the RSI either coming back out of its overbought or oversold areas as a signal or partial signal to enter a trade. So tips on using the RSI indicator should be like following. Sudden large price movements can create false buy or sell signals on RSI. It is therefore best used with the modification to its application or in junction with others confirming technical indicators. Some traders, in an attempt to avoid false signals from RSI, use more extreme RSI values as buy or sell signal, such as readings above 80. So here we mentioned 70, and they're using 80, or below 30 as 20. So that should indicate oversold or overbought conditions. The RSI is often also used in combination with trend lines, as trend line support or resistance often coincide with support and resistance levels in the RSI reading. It would be also very useful to watch for divergence between price and RSI indicator. So divergence occurs when a security or a currency pair makes a new high or low in price, but the RSI does not make a corresponding new high or low level. So here we have a bearish divergence and bullish divergence. So here, bearish divergence when price makes a new high, but RSI does not take, so it is taken as a sell signal. So we have here have the price actually is going up and RSI actually going down. So this is our sell or bearish signal. On the other side, on the opposite side, we have a bullish divergence where, and it's, of course, it is considered to be a buy signal. We have the prices making new lows, but the RSI actually does not support that. And this is a buy signal. Next indicator, it's MACD. And this is moving average, convergence, divergence. MACD is one of the most well-known and used indicators in technical analysis. This indicator is made of two exponential moving averages, which help measure momentum in an instrument. These moving averages and the changing distance between them become MACD. Convergence simply means the moving averages are moving close together, and divergence simply means that they are moving away from one another. When the short-term exponential moving average is above the longer-term moving average, upper area on the indicator will show activity. So here we have these two moving averages in our price chart, just to show you. And these two, this is 22 period and 22 period, sorry for this, 22 period, 26, sorry, period and 12 period. So their difference actually is our histogram, okay? So when short-term moving, exponential moving average start going above the longer-term moving average, then we have this activity. And of course, opposite, when the short-term moving average is below the longer-term moving average, then the histogram is showing this lower activity. The signal line, which is actually usually colored in red, is just a moving average of MACD values themselves. Typical values for MACD are 26 and 12 exponential moving average and 9 for the signal line. The further apart the moving averages, the greater is the momentum. The further away the MACD will be from the center line trades. And this is the central line trades. Traders also use crosses to indicate where momentum is coming out of the market and use it as a signal to exit a trade. Trading divergence. The classic trading strategy using MACD histogram is to trade the divergence. One of the most common setups is to identify points on the chart where the price makes a new swing higher or a new swing lower, but the MACD histogram doesn't. Similar like on RSI, which signals a divergence between price and momentum. And here we have this situation. The prices are lower and lower, and the histogram is moving in the opposite direction. Unfortunately, the divergence trade is not reliable or accurate, it fails more times than it succeeds. Prices often have several final volatile bursts or down that trigger stops and force traders out of the position just before the move actually makes a sustained turn and the trade becomes profitable. And Bollinger Bands. Bollinger Bands are a highly popular technical analysis indicator. A Bollinger Band is plotted two standard deviations away from a simple moving average. And here we have a simple moving average with standard deviation. So it is made of a simple moving average, which is a middle line, and then two standard deviations plotted away from it. Now, the important part is that because of the standard deviation is a measure of volatility, Bollinger Bands adjust themselves to current market conditions. When the market becomes more volatile, the bands widen. This is like here. And they just further away from one of each other. And during the less volatile periods, the bands contract, moving closer to the average. It's like this. The tightening of the band is often used by technical traders as an nearly indication of the volatility is about to rapidly increase, as volatility often follows the periods of lack of volatility. Excuse me. The market spends the most of the time within the bands, and when the price action reaches the edge of the band, like here, bands is often more likely to reverse and come back into the range. This is used as a signal by reversal traders to take a trade. This is similar to the oversold and overbought conditions on the RSI indicator. So this is not a standalone system. Bollinger Bands are not standalone system. If you're using just like that, you're probably not going to do good trading. They are simply one of the indicators designed to provide trader with information regarding the price volatility. It is suggested to use them with two or three other non-correlated indicators that provide more direct market signals. It is crucial to use indicators based on the different types of the data. Some of them can be moving average, divergence, convergence like MACD, or relative strength index. So let's how it looks when we put it all together. So here we have already looked at RSI, MACD, Bollinger Bands, and the use, of course, again, this moving averages just to make it more clear how MACD is moving. So here we still have like RSI, MACD. RSI is moving into overbought territory at the beginning of this chart. Remember that indicates that the market will reverse. However, we want something to help us filter out false signals on the RSI, so also we are looking at MACD to give us confluence. We can see it is indicating momentum is coming out of the market as far as the market relying or going up is concerned. And we have an MACD cross on the graph as a signal to enter the short trade. We can also use opposite signals as exit signals to indicate when the momentum is coming out of the market and it's more likely to reverse. If the market retraces back up the opposite direction of our trade, this can be used as an exit signal. And to addition to RSI and MACD signals, we can add further confluence to this trade with Bollinger Bands. We can see the market is at the top here of the Bollinger Band. So we can enter the short trade as now we have a confluence of three indicators. So we have RSI coming back out of the overbought. We have MACD cross with the market going to the edge of the deviations on Bollinger Bands. So here is Bollinger Bands are showing us. If we want to be more clear about the MACD, this is the moving averages where the faster moving average is crossing over the slower one, also indicating the short trade, and RSI, which is actually exiting here from the overbought position. Okay, so this is okay in the middle of this chart. It's not so easy to predict things when you're here at the end, but anyway, this is something just to show you how you're going to use and how you can use these indicators. So now we have confluence of three indicators, and this is something which is actually showing us that this was a moment for goods and signaling a good short trade. Okay, so I will try it here to show you on the MetaTrader how to implement this indicator. So here, indicator list, you open it, you can go on the trend, and here you have a moving average, for example, moving average. On the parameters here, you will write your period. So for slower, it's 50, for example. If you want to use simple, you will put it here simple. If you want to use exponential, also, you can change it here. Keep the closing price and the style, all the color is here. So this is something. If you want to use, for example, again, moving average, but shorter one, let it be 10 period. Again, exponential, closing price, this is it. So I think that we should here. So if you want to change something on your indicator, you could go this here on the indicator list and choose one. If you want to delete it, you can press here. If you just want to add it and change the color in a way just to make obvious which one it's which, you can use blue one. Okay, close. So you can see here that this lower one, 50 period, is a blue one. So again, if you want to enter some other indicators, here for a trend, you have a Bollinger Bands. Also, just use these commonly used parameters, don't change anything, and you will see this, the Bollinger Bands. Too much right now, indicator, sorry, we're going to indicator list. We want to delete all of them, and now we will just keep the Bollinger. And now we, for example, want to add moving average. We will go on the oscillator. Sorry, this is MACD. Again, keep this as we talked about. Fast moving average here and exponential is 12, slow 26. This is the signal line 9. And here we have this histogram. And then again, if we want to put RSI again on the oscillator, relative strength index. Again, keep all of this setups. So period 14, closing price, okay, and here we have RSI. Okay. Again, if you want to delete it, indicator list, choose which one you want to delete. If you want to add it, choose one which you actually want to add it, and change. If you want to save changes, okay. If you do not, of course, cancel. Okay. So basically that was it. We are closing to the end of this webinar. If you have any questions, you can ask it now. Okay, nothing. Okay, thank you. I now want to wish you all the best in your trading. Have a great week ahead and see you next week. Okay, Bye bye.